Hi, good morning. It's Dan Moorhead from Pantera. Thanks for joining this call. This is one of our monthly series of calls to educate the community and share our thoughts on the markets. Sometimes they're super deep dives on very specific and sometimes very technical issues. And then once in a while we do a more general one such as this, where it's an introduction to blockchain investing, where we'll try and go through some of the ways people get their heads around blockchain and why it's such a asymmetric opportunity. We have the entire investment team on the call with me. If you have questions, feel free to use the Q&A box. The investment team will be answering them as we go, so you can get real-time answers to questions if you'd like. And then at the end, we'll wrap up with some of the information about our fund offerings. The first thought is to just share the history of the firm for those of you who don't know Pantera. I started out as Goldman Sachs' first asset-backed securities trader in the 80s, and then went to Tiger Management, where I was the head of macro trading, and then founded Pantera in 2003. We managed $1 billion of very normal assets for that era. But in 2011, I got interested in Bitcoin blockchain, and we launched the first crypto fund in the US in 2013, and then a blockchain venture fund in 2013. And have since launched products across the spectrum to help investors get exposure to all the different blockchain assets. My partners are fantastic. Our co-CIO, Joey Krug, invented the first ICO on Ethereum, a project called Augur. And Paul Vradatocket and I have been partnered for 6 or 7 years on the venture side. And we have about 20 people, mainly based in the San Francisco Bay Area, attacking this opportunity. And the first thoughts I have before we dive into the details of blockchain are just helping people get their head around why this is an interesting opportunity. And people have really different perspectives. And I've seen over the years, certain things get caught traction in some people's minds, and other perspectives help other people. So the first one is even just the basics, money. Living in the developed world like the US, you probably don't think about money too much, but for those callers calling in from around the world, most people live in countries with terrible money systems. We've had various forms of money over the millennia, getting down to very precious things like gold or silver, and then there were convertible notes that were backed by those precious, rare things, and then governments realized it's more fun just to print them without any assets backing their currency, and that's been horrible for most people around the world. Even in the US has lost 90% of the purchasing power of the US dollar since 1950, so even in the US it's been pretty terrible. So in 2009, Bitcoin was invented as the first successful digital currency. There were decades of attempts to do that before that, but Bitcoin's the first one that really worked. And then Ethereum allows for much more interesting protocols that do things that ultimately are like digital companies. They're doing the things that we're used to companies doing, but doing it in a decentralized way with essentially almost zero friction. The easiest way to think about what Bitcoin is it's the final piece of the protocol puzzle that is the internet. The internet has all these different protocols that move all kinds of data around. But even in the 90s, Milton Friedman said the only thing missing from the internet was a reliable e-cash system. And that's basically what Bitcoin and other protocols are. The really fascinating thing for us in the investing world is it's the first time you can own a piece of it. All these other protocols that are listed here, you can't buy a chunk of them. If you think back to the early 90s, if you realized the internet was going to be big and you wanted to own a chunk of the internet, you couldn't buy a piece. You had to give your money to the sock puppet and hope he could figure out logistics. Here, you actually can own a chunk of it. Bitcoin, as an example, has 21 million shares. You can own a piece of the protocol, and the majority of the value in the industry has gone to the protocols themselves and not to venture-backed companies. So it's a really interesting and unique opportunity to own a chunk of the protocol that makes things work. Another perspective would be to think about it in the analog of what voice over IP did to the telephone monopolies. That's basically what money over IP is going to do to the oligopolists to control credit cards, correspondent banking, remittance, all these payment rails that are very expensive to use will ultimately be very inexpensive. If you think about the way the internet impacted our lives, it basically changed everything except for those businesses, finance. And back in the day, the AT&T actually was 16% of the US market cap, and now no one even thinks about the cost of bandwidth. It's going to be the same with money. Right now, it costs an immigrant a month's wages to send money over the main remittance corridors. It costs 300 basis points to swipe a credit card transaction, which is absolutely insane for 2020. All those fees are going to come way down, very close to zero, and the quantity of information that's going over the blockchain networks is going to explode. So the stack is becoming more interesting. Originally, it was just Bitcoin. That made it very easy to invest in the space. It is now, there are several layers. We have Bitcoin, which is kind of the, some people call it digital gold, and some people mean that as a compliment, some as a distraction. But it's very good at storing wealth. It's very good at transferring money across borders. If you want to do something more complicated, you have Ethereum, which is sometimes called programmable money, which I think is a really good way to say it, is you can make smart contracts that allow code to allocate money from transactions. The easiest one to visualize in my mind is gambling. If you have a blockchain-based roulette system, if the wheel stops on 00, you pay this person. If it doesn't stop on 00, you pay the other person. And that is a smart contract. You can obviously make them much more complicated if you wish. And then now you have things like Polkadot, which are kind of taking everything to the next higher order of magnitude, many orders of magnitude more throughput and interoperability between the different various blockchains. The next topic to talk about is something that's coming into vogue now is central bank digital currencies. China is the leader in this space. In October of last year, a year ago, October, they announced that they were going to do a central bank digital currency. That was not coincidentally announced 2 days after Facebook said they were going to do a stable coin. And now the US government has a program, and many major central banks are trying to figure out what to do with central bank digital currencies. They are different than Bitcoin or other brands of blockchain. They're essentially pegged to or backed by fiat currencies. Fiat currencies have some problems, of course, with being debased, but the current version of fiat currencies are really clunky. It's very slow to move them. There's all kinds of controls about what countries you can or cannot send from and to, whereas a central bank digital currency has a lot of the benefits of tokens, such as instantaneous transfer and borderless distribution. So they are hopefully going to be able to access the billion people on Earth that are not well served by traditional banking systems, but do have a smartphone, and that is a huge opportunity. With that, I want to hand it over to my partner, Joey Kroot, to talk about the opportunity in blockchain.
Thanks, Dan. So I want to give a kind of high-level overview of decentralized apps, and then we'll walk through decentralized finance and open finance, which are some of the use cases that are really starting to gain early traction in the cryptocurrency space. And so in this slide, if you look at decentralized apps, sort of the core idea is in Web 2.0, you have all these companies that are basically middlemen, and they extract rent from both sides of the table. So on a platform like Airbnb, they're basically charging a bunch of different fees. Some of them go to your local jurisdiction. Some of the fees go to Airbnb themselves. And they basically get charged on both sides of the trade. The person who's renting you a home, and then you yourself also pay a bunch of fees. And the idea behind decentralized apps is basically, well, what if you cut the platform out in the middle and replace it with some sort of public protocol or sort of public open infrastructure, and drop the cost for these things really dramatically? And so that's kind of the core idea. You can do this for tons of different things, not just versions of Airbnb. You could also do it for online gaming. You could do it for things like the browser itself. Brave is a great alternative to Chrome, as an example. You can do it for file storage, where Filecoin is basically trying to compete with Amazon's Glacier storage. So right now it's still too slow to do things like compete with AWS S3 outright, but with AWS Glacier, which is kind of their slower storage for backups or archives, Filecoin is actually pretty competitive on a price standpoint. It's usually about 2 times cheaper for the equivalent service. And so that stuff's starting to happen. There's not a whole lot that's happening in Web3 at the moment, though. I'd say it's still pretty early. And most of the things happening right now are happening on the financial side. And so if we go to the next slide, we can kind of give an overview of decentralized finance, or some people call it open finance. And the way I think about this is, if you think about how the internet was the underpinnings of a new information infrastructure, blockchain tech and crypto are the underpinnings of a new financial infrastructure. And if you look at any financial system, it really has 5 primitives, or 5 kind of basic components that you need for any financial system to work. The first obvious one is you need a unit of account. You need some sort of currency that can be used for trade and commerce that's relatively stable. The next one is you need an exchange that lets you actually trade assets. The third piece is you need assets to trade. So these could be existing assets in the real world. They could be synthetic assets, things like derivatives, where you're effectively taking some sort of bet, but there's no actual underlying. And it can be sort of anything in between. And the last 2 components are margin and leverage. And so the example I use is, like, without margin or leverage, trading things like dollar or yen are very uninteresting because it doesn't move that much. And so really, to get good exposure or to make a good position that you want to hedge, you really kind of do need those 2 last components. Those are probably the hardest ones to do in a decentralized manner, but people are starting to do them now too. And so we can kind of zoom in and look at what projects are actually doing these individual components, and kind of what the, in tech terms, what the stack, or what the different kind of components in the DeFi ecosystem actually look like. And so at the very bottom, kind of pretty far removed from the user, you have these layer 1s, so these blockchains that let people run smart contracts that Dan mentioned on them. So things like Ethereum and Polkadot and Near and Cosmos. One layer above that, you have kind of infrastructure that's used to get real world data into the blockchain. These are known as oracles. There's ones that are pretty fast, platforms like Chainlink, and then there's ones that are super slow that give you kind of different security guarantees, like Augur. And then above that, you have some things that people actually use kind of as an end user. So you have lending protocols like Maker and Compound. These basically enable you to take a loan 24/7, 365 days a year. The example I like to use is, if you want to take a loan at 3 a.m. on Christmas Eve, you can do it on a DeFi app like Compound or Maker. Maker is unique in that, as a byproduct, it actually produces a stablecoin called DAI, which is pegged to the US dollar. So their lending actually issues new currency, which is really fascinating. And that's been around for a few years. The peg of DAI has kind of floated around from like 98 cents to, at some points above $1 a bit. But it's been fairly stable, and it has actually worked, which is really interesting. Then you have decentralized exchanges, things like 0x, Kyber, Uniswap, where people are trading these tokens in a decentralized manner. You have marketplaces like Filecoin. You have kind of payment applications, things like Terra and Flexa, which are basically use kind of some of the benefits of DeFi to do more effective payments. Terra is a great example because they do billions of dollars in payment volume a year, based in Korea. And then if you kind of go up one more layer up the stack, you have things like Injective Protocol and PowerTrade, which are effectively decentralized derivatives exchanges. And then you can kind of go one layer up above that. You have things that are kind of aggregators or wallets, or things that really touch the end user directly. An example of this is something like Yearn.finance, or YFI, which lets you basically, you give them money and they try to find you kind of the highest yield you can get for whatever asset you hand them. So it's a pretty simple interface. You say I have USDC, I want to earn as much interest as I can on it. I'll send it to Yearn, and they'll go out and basically manage that for me. So they have these sort of like single asset strategy kind of fixed income products is effectively what Yearn offers. Instant App's a UI that lets you interact with all this DeFi stuff. And I guess the last kind of category of aggregator is probably the most interesting one in the market right now is these decentralized exchange aggregators. So projects like 1inch and Matcha. And they let you basically, you give them money and they route your order across 25 to 30 different decentralized exchanges. What's really cool about this is it's like the first time I think that DeFi has built a product that's actually much better than what exists in the centralized world. So say you want to do an OTC trade of one ERC20 cryptocurrency for another. Usually, depending on the currency, you can usually actually get a better price trading it through one of these aggregators than you can actually going outright to an OTC desk. Obviously, if you're trading really large size, you're going to have to go to the OTC desk and they'll do your order like, TWAP or VWAP it or whatever. But, sub $1 million, these aggregators actually usually give you a better price, which is really cool. And so the last thing I wanted to cover before kind of handing it back to Dan is the growth in decentralized finance. So DeFi has been something we've been talking about for a really long time. And, for the longest time, it felt like it was kind of just a drop in the bucket. And it was something that would, someday it would happen, is effectively what we said. And now it's actually finally happening. So when we first started talking about it, in 2017, the amount of value locked in these DeFi protocols effectively round down to zero. Decentralized exchanges were effectively trading no volumes. Again, it rounded kind of down to zero. These days, at the beginning of this year, there was around $1 billion locked in DeFi apps. Now there's about 12 to 13 billion. That's how much capital is being deployed in these decentralized finance applications. So the market still has an insanely large amount of room to grow. One way to think about it is to think about it like an asset manager, like BlackRock or something, which has hundreds of billions of assets under management. The DeFi is very small in comparison, but it's growing very quickly. And then decentralized exchanges are something that we thought might take 5 years to get a lot of adoption, and they're already starting to get good amounts of traction now. The beginning of the year, they did maybe a couple $100 million in volume a month. Now DEXs collectively do about $20 billion in volume a month. So that's on par with many centralized exchanges. So the market is growing really rapidly, which is exciting to see. And we think as scalability starts to become more real, this growth is only going to continue.
So the fundamental case that Joey has presented on the tech spin there has been growing for many, many years. The huge development this year is the macroeconomic explosion in money, basically. And I've been a macro trader for 35 years, and I've seen a lot of interesting things, but the economic response to the virus has been just off the charts, literally. The first chart is a chart of the US debt printing since its founding. In June, the United States printed more debt than in the first 2 centuries of its existence. That has to have an impact. You can see on the next slide the growth in money supply in some major currencies, the US, Brazil, and the top line, the little gold thing, that's Bitcoin's money supply. And that really is the story, is paper money is being printed at an unprecedented rate. The chair of the Federal Reserve said it's an unlimited amount of money that the Fed can print. And that is causing the value of the money to be debased. The flip side is you see the number of pieces of paper it takes to buy something like gold or stocks or Bitcoin going up. Bitcoin's money supply formula is absolutely fixed. Every 10 minutes, 6.25 Bitcoins are issued. And it doesn't matter if there's, housing market crisis or the stock market's gone down or whatever, they're not going to print more. So it's kind of like the gold standard. On the next slide, it shows that in the emerging markets, people already get it. The value of Bitcoin priced in the local currency for billions of people on Earth hit a high way before it hit a high against the US dollar. That little vertical line there is the Venezuelan bolivar going right off the chart in 2018. And you can see, Argentina, Turkey, all these other countries have been seeing their currencies depreciate relative to something like Bitcoin that is a gold standard type currency. So that's where we're seeing a lot of take up of Bitcoin is in the emerging markets. On the next slide, it's a view of an old adage on Wall Street: don't fight the Fed. Most of my history, the central banks of the world were trying to reduce inflation. We're in a very interesting time when they are promising to double inflation. Reducing inflation is very tricky, takes institutional commitment, takes decades, really hard to do. Creating inflation is very easy, as Zimbabwe and Venezuela and other countries have proven. The US says they want to have inflation average at least 2% over a period of many years. Given that it's at 1% heading south right now, that means we're going to have inflation at much higher levels for much longer than most people are thinking. That will certainly do the trick. It's very bad for the value of the currency, though. On the next slide is a value of the Japanese yen. When they began printing money, they, of course, invented quantitative easing. They invented zero interest rate policy. So Japan is basically the canary in the coal mine for all these policies that we're now seeing roll around the rest of the world. The Treasury Secretary designate, Janet Yellen, said that it could be a good idea for central banks to buy stocks with printed money. This is the country that first did that, Japan. It's not good for the currency. It's terrible for the currency. And on the next page, we actually have a real-time shot of the US dollar. This is the US dollar versus its trading partners, the trade-weighted dollar. And it had a kind of a knee-jerk flight to safety rally when the pandemic started, but has essentially been getting crushed since then. And so you want to buy essentially the least bad currency. And as you print more and more of US dollars or euros or Japanese yen, all of those are being debased against other assets. And those are on the next slide, which has the performance of other assets relative to paper money. And essentially anything that can't be quantitatively eased is going up in value. And including, I think the proof of our thesis here is the S&P 500 is up 12% in the worst global recession in at least 100 years. That doesn't make any sense from kind of a discounted cash flow mentality. The S&P 500 earnings are estimated to be down 30% during this pandemic. The fact that the stock market's up 12% shows there are just trillions of new pieces of paper chasing the same quantity of assets. Things like gold that actually have a fixed quantity are up even more. And then cryptocurrency assets are doing very well because they're not only fixed in quantity, they actually perform very well in a pandemic. The usage of cryptocurrency is exploding during this pandemic. Things like, obviously Bitcoin is the most high profile thing that people, focus on as kind of the bellwether for the industry. It's up 168% year to date, but other things like Ethereum are up double that or even more. And that's why it's important to have exposure to more than just Bitcoin. The last thought on macro is a divided government in the US should be or would likely result in more pressure on the Federal Reserve to print even more money. The results won't be out till January 5th when Georgia's done with their Senate races. But if we end up with a divided government, I think that's very, very good for Bitcoin and blockchain asset prices. Here's a graph of the Fed's balance sheet overlaid with the graph of the price of Bitcoin. I don't think it's coincidental that they're going up together. And why we're interested as investors is this is the most asymmetric trade I've ever seen. My whole career has been looking around at things like Russian privatization or, Argentine farmland or Tesla Motors or whatever. And this is just so much bigger than any of those trades. It's orders of magnitude bigger than the other trades that I've invested in over my career. And this is just some of the use cases, digital payments, wealth storage like gold, money. And ultimately, I think blockchain is a new asset class. So you're talking about 200 trillion of stocks, bonds that are investable out there. So Bitcoin has amazing potential upside against these things. And the reason it's an important thing to have in one's portfolios is the only thing that's still uncorrelated to everything else. And as we saw in the crisis in March, everything goes down together. Oil, gold, S&P, they all are connected for the simple reason that everyone basically has the same portfolio. Portfolio theory has been so successful that basically everyone owns the same stuff. So when people are seeking shelter and trying to reduce risk, they're selling the same things across the board. Bitcoin is very lightly owned by normal institutional portfolios. So it does have a very short 1 to 2 month correlation with the rest of the world, but this is the long-term correlation is basically zero against other asset classes. So if you find an asset that has a 9-year, 209% compound annual growth rate and it has zero correlation to everything else, you want to put that in your portfolio. It's a very unique asset. Corporations are now putting in their portfolio. There are a few public companies that now have put their treasury cash into Bitcoin, with cash yielding essentially zero or negative in a lot of countries. There's definitely a need to look for something else to diversify into. Square MicroStrategy have put now billions of dollars into Bitcoin, and the value that's increasing dramatically on their balance sheet. A very big announcement beyond that. Obviously, Square's Cash App's been consuming 40% of all the newly issued Bitcoin in the 30 months since it went live. 6 weeks ago, PayPal went live with their 300 million users. That is just a huge quantum leap for the number of people that can easily access Bitcoin. This is a proxy of how many PayPal customers are buying Bitcoin. This is using their infrastructure provider, itBit. Paxos owns an exchange called itBit, and this is their volume on a real-time daily basis, showing that it used to be very, very stable, that solid white line, and as soon as PayPal went live, it exploded up, and it's already consuming 70% of all the newly issued Bitcoin. So Cash App, Square, and PayPal are already buying more than 100% of the entire new supply of Bitcoin. And as people get more interested in the space, that's likely to keep growing. So we'll keep updating this graph over time, but to me, it's one of the biggest themes in Bitcoin right now. And then one of the detractions for Bitcoin is it is very volatile. There's been some 90% bear markets. But even net of all that, Bitcoin has only gone down once and created a lower low. And although it's gone down 80 or 90% 4 or 5 times in its history, even at the end of those bear markets, which in any other asset class would shut the asset class down, Bitcoin has ended up at a higher price than the previous low. Here's a graph of those rallies and bear markets graphed in log basis, so that it takes into account the exponential growth of this very disruptive asset. And you can see it is actually pretty stable. As I said, it goes up 209% on average. There have been some crazy bull markets that in hindsight are now thought to be bubbles in 2013 and 17. And then there's been some, very serious bear markets, but net, it does kind of grind up at a fairly consistent rate. And those rallies typically last, a year or so. And I think given that the fundamentals, both from the technology side, and from the global macro side are so strong, I think we're in for a year or two of a big bull market here. We are now at the highs that we touched in 2017. Question would be, is it a good time to invest? On the next slide, it shows the deviation from that 10-year logarithmic trend. We're still well below what the trend would imply the price should be today. We're at about half of the price that the trend would have put us at. And so, yes, there's been probably better times to buy, but this is still probably a very good time to get engaged in the market. And with that, that's the end of our kind of macro thoughts. I want to give just a quick overview of the 4 different funds that we offer to allow people to get access to the whole spectrum of blockchain assets. We have venture funds that invest in companies that use blockchain to do something better, faster, and cheaper. And then we have 3 hedge funds: a daily liquidity Bitcoin fund, quarterly liquidity fund that trades liquid tokens, and then the ICO fund, which invests in tokens prior to them going public. And with that, I wanted to let Joey talk about a couple of the funds, and I'll come back to talk about the Bitcoin fund.
Great. For the first fund, I want to give a high-level overview as the digital asset fund. And the digital asset fund is a multi-strat hedge fund that manages assets basically in the liquid kind of public sphere of digital currencies. And so it's trading things that are, typically in the top, 50 to 75 or so on CoinMarketCap. They're already publicly traded. The thesis here is to buy things that enable a lot of these real world decentralized finance use cases. And then we own some, positions outside of that effectively are a hedge in a thesis sense to our DeFi views. And the fund is split 80-20 into an 80% discretionary portion, where we're investing in the assets that we think have sort of the highest growth potential in DeFi. And then the remaining 20% is a quantitative strategy, where we're basically kind of constantly trading towards a new portfolio. And we update, our models basically update on an hourly basis. And so the quantitative portion is sort of not super correlated to the discretionary piece. So it adds some diversification to the fund. And if you look at this slide, you can sort of see what the portfolio kind of looks like at a high level. If you look at the market view, the market basically puts a huge emphasis on payments and store of value use cases. So things like Bitcoin and then competitors to Bitcoin. Our view is that Bitcoin's going to win the store of value race, and so there's not really any sense in holding Bitcoin competitors in the fund. And so it does own some Bitcoin, but we basically underweighted everyone trying to compete with Bitcoin itself and overweighted smart contracts, open finance, DeFi, Ethereum, things like that. With the thinking being that that's where the value in this space is basically going to come from two areas. One being digital gold with Bitcoin, and the other area being smart contracts and DeFi. And our view is that for the most part, it's not really worth owning the people who are, trying to create Bitcoin plus or whatever, because Bitcoin, in our view, is going to win the digital gold race. The next fund I want to give an overview of is the ICO fund. And the ICO fund is investing in early stage tokens. So these are before they're publicly traded. We invest, basically if they're doing an auction, pre-auction, we buy tokens usually through an instrument called a SAF, which is just a simple agreement for future tokens. And, we buy them at either a discount to a public offering, although that doesn't really happen that much these days. Usually you're just buying them with a valuation cap. So, you might buy into a token at a valuation of say 30 million, and then it goes tradable and it's trading at, 80 to 100 million, something like that. And for a while, the ICO space had cooled off quite a bit, but it started to heat up some again. A few kind of sample investments we've done recently, we invested into, a while back, we invested into Polkadot, which has been a great position for the fund. It's up a really large amount. But recently, kind of some earlier stage investments, we invested into a project called Injective Protocol, which is a decentralized derivatives exchange. It actually just launched their testnet yesterday. And then we're also investors in Akala, which is basically a DeFi blockchain built on top of Polkadot. So they're trying to make it really easy to write decentralized apps and get users from platforms like Ethereum running their apps in a more scalable fashion on Akala. That's sort of their angle. So they make it really easy to deploy those Solidity apps onto Polkadot. And I'd say we're seeing more deals now in the ICO space. There's probably one really good deal that's actually worth investing in, I'd say every 2 months. And then we get a bunch of deals each week that we're looking at. There's kind of a small subset that are actually great investments. Then Dan's going to walk through the Bitcoin fund.
Yeah, so the common questions, what's the best way, what's the most efficient way to get exposure to Bitcoin? I still think our fund's the most efficient way to do it. There are a couple of other ways one can do it. You can open an account at an exchange like Coinbase or Bitstamp. There you have to pay the bid offer spread, trade it. And if you're buying, 5 or 10,000, that's probably the best way to do it. But if you're buying, half of, 100,000 or more, it's more efficient to do it via a fund. Our fund has investors coming in out at mid-market from the value weighted average price of any US banking day. There's no lockups, daily liquidity. You can come in today and come back out on Friday if you want. And we have a few of the advantages on the next slide relative to some of the other things. Most of the other or all the other products that I'm aware of charge higher fees, and some even have very large premiums to the net asset value, which seems quite dangerous to invest in a Bitcoin fund at a high premium, because ultimately someday that premium will go away. And then on the last slide, we do have the full spectrum of our funds. We have 4 different funds, the daily liquidity Bitcoin fund, the 2 quarterly liquidity hedge funds. Both of those have, or all 3 of those have no lockups. So we want to pass through the liquidity of the underlying assets to you, the LPs. And then in 2021, we will be raising our 4th venture fund. So if you have interest in the venture fund, it's not currently open, but it will be open soon. So you can let us know. We'll keep you updated as we go live. With that, I wanted to open it up to questions. We've answered a bunch of them, as we were on the call, but happy to answer some of the more generally interesting ones. There was a question about central bank digital currencies and are they, bad for the ecosystem. That was a passionate argument when Facebook's Libra project was coming out, and then, other central bank digital currencies announced after that. I'm a strong proponent that it is all very good for the ecosystem. Bitcoin and blockchain have spent 10 years, 12 years gathering maybe 100 million users, which is really cool. We're very proud of that. But other entities like Facebook are coming in at orders of magnitude bigger than that. So if Facebook brings 2.4 billion people into the cryptocurrency world, yes, quite a number of them will just use a very simple stable coin. But if 5 or 10% of 2.4 billion people start using Bitcoin or Ethereum or XRP, that's great for our industry. And likewise, when central banks put their imprimatur on tokenized, currencies, that's just a good thing. It's going to make their citizens more likely to want to experiment with things other than a tokenized piece of paper money. So they would, try out other currencies in the space. So I think those are net all very good. There's a question on the legal perspective of the market going to larger implementation. I would say that the regulatory issues are essentially all, almost all behind us, with the exception of the SEC, which hasn't been completely transparent about its views on various projects. All the other agencies in the United States and mainly around the world have all ruled very favorably for cryptocurrency. For example, the IRS ruled 7 years ago that cryptocurrency was property. So you can get long-term capital gains tax treatment if you hold it for more than a year, which is much better than the taxation of gold or currency itself, paper currency. So it seems like, with the exception of the SEC, which is definitely holding the industry back a little bit, all the rest of the regulatory stuff's in place. Big news 4 or 5 months ago was the OCC, which controls nationally chartered banks, has allowed all nationally chartered banks to custody cryptocurrency, which is a huge, huge step for our industry. And with that, I think we've answered many of the questions. I'll hand it over to Joey to answer a couple that are more appropriate for him.
Awesome. Yeah, so a few of the questions that we've been kind of looking through in the chat. Somebody asked, can other smart contract platforms catch up to Ethereum? My view on that would be Ethereum is in a really good position right now. I think, especially because literally today, the first version of ETH 2.0 launched, and within about a year or so, the kind of underlying groundwork will be there to enable people to write scalable apps on Ethereum. And so if you're competing with it, you effectively have to start to get product market fit between now and the end of whenever the next version of ETH 2.0 launches. I think of the products in the space, the ones that are kind of best well positioned to do that are Near and Polkadot. I think they will get some traction, but they're not going to unseat Ethereum per se. People will use them for different things, I think. They'll find some niche in the market where they get traction, and I think that's kind of how it's gonna play out. I don't think there'll be one winner per se, where it's a winner take all sort of thing. But I think Ethereum will likely have kind of dominant market share, at least for the foreseeable future. There's another question about, Web3 apps. If they charge lower fees than Web2, how do they achieve profitability? Is it lower operating cost? Yeah, the costs to operate are definitely lower. So, if you think about it, if you take something like something really simple like Uniswap as an example, the operating expenses for that are very low. The first two versions of Uniswap were built with a team of like 10 or less people. And you can compare that to a company like Coinbase, which probably has over 1,000 people. And the operating expenditure is just, sort of no contest. So I think that's one of the ways. The other part of the answer is just kind of getting comfortable with, we don't know all the answers there either. If you look at, innovations like the internet, and you say, okay, well, anybody can post information online however they want. How will we monetize if we're, insert kind of media company name here? Sometimes these businesses will just disrupt the way things work, and the profit model is not necessarily obvious from day one. Google is a great example of that. A lot of investors passed on Google because they had no business model. And then, of course, obviously, they figured out ads, and it's one of the most valuable companies on the planet. So I think people will figure it out eventually as well. Another question that's like, what is our due diligence process basically for kind of new tokens? I'd say it looks a lot like a DD process for any investment you would make, particularly any startup investment. We're talking to the teams a lot, looking at the team, do they have the characteristics and qualifications that you would want for somebody building a project in their space? How strong is their go-to-market? How large is the market opportunity? How practical is this? Like, is the timing right? Is this something that, really can't exist until it's easy to do 10,000 transactions per second? If so, we wouldn't invest. Asking those sorts of questions. I think those are kind of the main questions I see in the chat anyway.
Well, there is one that question about, can one buy into the Bitcoin fund via a retirement account? Yes, all of our funds are available through IRA providers. We have about 6 different ones, like Pinsco Trust. So if you're interested in investing via an IRA, we can definitely do that. Another question is, how can one get invested in the ICO fund? If you contact our investor relations group, either on our website or ir@panteracapital.com, we can set you up. The hedge funds money comes in at the end of every calendar month. For the Bitcoin fund, it's every US banking day. And then the hedge funds have quarterly redemption. So if one wants out of digital asset fund at the end of every calendar quarter, you can come out. And there's a question on, do we have short exposures in the digital asset fund? We don't currently. We've set the fund up to be a long short hedge fund for essentially the long term, the 5 to 10 year horizon. Right now, we're very bullish on the space. We think a year's time, the markets will be much, much higher than they are today. So the fund is only long right now. But I can imagine a world where, when Bitcoin's at, say, $200,000 per Bitcoin, we would have, meaningful short exposure, meaningful long exposure. And so the fund is set up. It's a evergreen hedge fund. Hopefully it'll be around for decades to be a long short fund. But right now it's fully long. And I think we have now answered all the questions that I've seen. If you do have a question that occurs to you after the call, feel free to shoot an email to ir@Pantera Capital. They'll route it to Joey or Paul or me or whoever's best to answer it. And with that, I want to thank you for joining and participating in the call.